This video discusses the Board of Directors' role in financial stewardship for an organization. You'll learn about key financial issues Board of Directors face and hear some best practices and tips on how you can improve financial stewardship in your organization.
Hello, and welcome to our discussion about financial stewardship, a session designed to provide information to boards on best financial practices and hopefully help you as a board member think about your role in financial issues. My name is David Taylor, a healthcare partner with Forvis, a leading public and advisory firm recently created by a merger between two firms you might recognize, BKD and DHG. My background is everything financial with healthcare organizations, primarily audits, cost reports, in the early years, but more recently consultative special projects, including financial forecast and feasibility studies. I've spent a variety of time with a wide range of healthcare organizations, ranging from $1 million all the way up to organizations nearing $1 billion in assets and revenues. I think this has provided me the background needed to see how different rural organizations navigate financial issues. Throughout the presentation, I'll refer to the governance group as the board. Since we're focused on financial issues, this information definitely applies to finance committees, which some organizations may have that serve underneath the board. At a very high level, think of a board's responsibilities in two boxes: operational and strategy. You can also think of these as short-term or longer-term areas. The balance of these two is critically important for a well-functioning board, and we'll keep coming back to this theme throughout the presentation. As we discuss various issues, keep this balance in mind. Issues can involve both. Let's consider a hospital with a key service line. It's important for a board to understand both sides, how the service line is performing today and the key operational issues, but a board also needs to understand the strategy impacting the service line. What's the long-term view of that service line? What are the growth prospects? What's the competitive landscape? And are there key investments needed to support or grow that service line? Finding a good balance between its operational and strategy is also influenced by management teams. You might have executives more focused and stronger in operational issues versus thinking about strategic issues, or vice versa. Boards need to assess management and where they are stronger and be ready to be flexible and be ready to support or encourage management if needed. The current environment also impacts operational versus strategic balance. For example, when COVID started, organizations quickly pivoted towards operational issues as they were facing numerous challenges and issues with providing just the basic services that they do. The last comment on the balance is some operational knowledge is essential for thoughtful strategic thinking. Think of operational knowledge as the building block needed to evaluate strategic issues. Without some operational knowledge of any organization, it's hard to see a board member being able to effectively make too many contributions to thoughtful strategic thinking. I think these issues demonstrate the balance between operational and strategic thinking and show it's a moving target. And there's really no right balance for all organizations. Organizations need to be flexible based on the factors we've outlined, and keep this balance in mind as we move through the rest of the presentation. I think right now is a good time to ask Mary Ellen a question. Mary Ellen, what do you believe is the appropriate balance between boards and operational and strategic issues? And do you feel like most organizations get this balance right?
So I think the appropriate balance between the board's focus on operations versus strategic issues is somewhat dependent on the situation and what's going on in the industry right now. I know that when we were going through COVID, we were focusing a lot on hospital operations. Really, strategic issues were put on hold for a period of time as we were dealing with staffing and logistical issues of getting supply in and things that are very routine operations. But in general, if you take a pandemic out of things, I think that the board should be focused more on strategy and vision and direction the organization is going, and that the operational components of what's happening in the organization need to be presented to a board, but not necessarily discussed and have a long period of time on the agenda. So the way we do that is that sometimes we will use committees to allow for the discussion to take place outside of the board meeting. So for instance, a finance committee, or maybe a performance improvement quality committee of the board. And so the details could be discussed in those meetings, and then at the board level, it becomes something that is presented for informational purposes, but not through discussion. The best way for the board to spend its time is really on where do we need to go as an organization to ensure sustainability for our future and our ability to continue our mission.
Thank you, Mary Ellen. My personal opinion is organizations could spend more time on strategic issues. Perhaps this is a function of the complex nature of healthcare, or a result of the past 2 years, or because smaller organizations don't have the scale to focus on planning. But a key role of boards is to support the organization moving forward financially, which includes developing long-term strategy. Organizations tend to settle into a rhythm of monthly reporting and other operational updates, but can struggle to find the time and focus to evaluate long-term issues facing their organization. Mary Ellen, how have you seen successful organizations address strategic planning and related implementation?
I think strategic planning is the most important thing that a board will have to address. And I think that many times strategic plans are great ideas that end up being, on a bookshelf and not actually executed. And that's where the hard work comes in. The best strategic plans are those that are actually actionable and are discussed at every meeting. The way I do that at my hospital that I think has been effective is that we take the strategic plan and we break it down into annual operating plans. And we call those our management plans. And that management plan is done in conjunction with the budget so that we know that we have funding for those strategies in our budget. But then at every board meeting, we are presenting our progress toward those goals and toward those strategies that we're trying to achieve. So I think the cascadingness of a strategic plan is real important, that you have the overall vision and that it gets broken down to how you could implement that vision in 1 year increments so that it becomes manageable.
Composition and competencies within the board is also important. We're going to digress for 1 second and talk about the audit function. Having at least one well-versed member in the audit process is needed. Auditor jargon is very technical and not always the easiest to understand. A member to understand the jargon and work closely with auditors is a must, especially since one of the roles of the board is to hire audit firms. Larger organizations might even consider an audit committee under the board to facilitate the audit. This allows a more specialized group to dive deeper into audit issues and help communicate audit issues to the board. The annual audit is an important and valuable process on where an audit committee member should be highly engaged. Part of designing an audit includes the board and gathering their input. To the extent a board is engaged with the audit firm in communicating concerns and risk, the effectiveness and value of the audit should increase. Mary Ellen, what are some good examples from your experience on how audit firms and boards have collaborated to help the audit monitor financial statement risk?
So the audit is a very important function for the board. And one thing that I think is very important to point out is that the audit firm is working for the board. And it's the board's engagement service that they're working on. So it's management facilitates the audit in terms of making our books available and our information available to the auditors as they're looking through things. But the service of the audit is for the board. The best examples of the collaboration that I've seen with the auditors and the board might be in certain areas that might be high-risk areas. They will help us identify high-risk areas and give board insight as to how they might want to monitor that. Some of the things that we experience in today's world with cyber risk, with other types of insured risk, and how do we manage that, and bringing those vulnerabilities forward for the board to consider and make sure that we are evaluating. So I think that's an important way where the auditors can work with the board and give advice. The other thing that I think is important for auditors is to help the board understand perspective as to where our financials are in comparison to what the industry and our peers are. As a rural hospital, our margins are different than what we might see in the larger facilities. And so give some reference to the board as to what that means for our hospital and how we compare to our peers. That helps us identify areas that might be vulnerable, that might need to have some improved operational policies and practices put in place to get us to where we need to be. That relationship is real important. It needs to be an open exchange, a very honest exchange. And I think that even at times the auditors could have conversation directly with the board without management there, so that there's full transparency and ability to ask those kinds of questions if there is some concern about how the management of the hospital is addressing certain aspects of the financials.
Next, let's go back to those starting points that we opened with, and that is taking a deeper dive at the two areas outlined, operational and strategic balance in boards. First, we'll start with the operational and some ideas for a well-performing board. The operational role is typically structured around most organizations. Members periodically attend meetings and receive and review financial information with operational and informational updates. Let's pause and challenge what those periodic meetings look like. Several questions come to mind in terms of the quantity of information received. What's the effort to produce it monthly? Could information be reviewed quarterly or annually? Is all information reviewed each month, or does it only include information relevant to a few? In my experience, this information doesn't change much and only gets longer over time. I think a good takeaway here is boards should periodically scrutinize the volume of what this information is and how long it takes to produce it. What about the quality of this information? Is it easily understandable? Does it include key drivers of financial performance to help explain the financials? Are there key ratios to translate financial amounts? Does the information compare metrics or benchmarks to internal goals? Are there narratives helpful to include and understand financial packets? Similar to the quantity of information, a periodic review of the quality of the information is also a good practice. One final point is how the information is communicated. Generally, informations will post updates to a portal or circulate, with the goal of allowing some review time before the meeting to make that meeting time even more impactful and more successful. Mary Ellen, how do you believe organizations should evaluate the quality and quantity of information a board receives? And do you have any perspectives on best practices surrounding this information?
So the quality and the quantity of the information that a board receives is a tough balance, to be honest with you. I think it's very important to be very transparent with a board, but I want to respect their time. Most board members are volunteers and they're giving us their time and talent, so I want to be respectful of that. So one of the things that I have done that I've seen others do that I think is very effective with time management with a board is that I prepare a board packet. And within that packet is a lot of information that isn't necessarily items that are going to be discussed on the agenda, but it's sort of for their information. So a lot of the operational situations status on maybe a construction project or an implementation of something that we're doing, maybe it's an information system or things like that, I will write it up and put it in the board letter or the memorandum that goes with the board packet. And there might even be some supplemental information that I provide with that. But it doesn't mean it has to be placed on the agenda for an in-depth conversation. It's available and it's something that they can ask questions of at the board meeting if they feel like it needs to be something to be addressed. I think sometimes we can get very focused on the financials of the hospital, and I understand that a lot of rural hospitals are on the edge, and financials can be very important, but really the essence of what we're here for is to provide great patient care and to serve our communities in that regard. So focusing time on the quality of the performance is extremely important.
As mentioned earlier, I believe most organizations can spend a little more time on strategy versus operational performance. Of course, organizations need to understand short-term profitability and factors impacting performance. However, if a key role in the board is to support longer-term planning, quality time needs devoted to these issues too. This is a great transition to our next topic, which covers budgeting, a key part of planning. Some of my expertise is in financial forecast, which are very similar to budgets. When reviewing forecasts with clients, I try and focus on the input, that is the assumptions within the forecast, versus the output and just what the financials are telling us. I think this mindset could help boards understand the key business drivers impacting the financials, while also increasing that organizational and industry knowledge. This knowledge will help challenge budget assumptions. For example, local employment trends could impact a hospital's payer mix. Payer mix changes have a direct impact on profitability due to reimbursement rate differences. Since board members have this local insight, this is one area where board members can be very valuable. Healthcare organizations are also tied to other demographic changes. All providers will be faced with higher demand in Medicare volumes in future years as baby boomers start utilizing more services. Since healthcare organizations are a function of local economic health, understanding this dynamic will help boards evaluate those budget assumptions. If the economy is doing well, more patients will have coverage, be able to pay, and won't defer services, which should support demand. Understanding revenue changes is complex since it involves demand for services, reimbursement rates received, and shifts in markets or market share. Once revenue assumptions are finalized, determining what level of expenses will be needed to support those revenues is a typical next step. Expenses inherently can be controlled more, therefore it's typically more straightforward versus revenue assumptions. Salaries, wages, benefits are the largest expense and easy to calculate with FTE and annual increase assumptions. Once the operating statement is finalized, capital budgets and debt service can be added in, and a cash flow forecast can be generated. Mary Ellen, what have you seen for best practices in the development of annual budgets?
Budgets are a very important function of the board in terms of approving the allocation of resources that we're going to be able to use through the next fiscal year. So one of the first things that I think needs to be done and is most important in a budget is the assumptions that you're going to be using in formulating that budget. A lot of times we look at historical data. What's our trends over the last 5 years, and do we expect those trends to continue? But you also got to look at what's going on in the marketplace and how that might be affecting you. Some of that could be cost of goods. We know that that's a big issue in today's world with supply costs going up a lot. It could be salaries and wages. Again, that's a huge factor that's affecting us in this year as opposed to the prior years because of the way wages have been inflated and the loss of staff in the workforce and how we've had to compensate with agency and some of these other things. So you want to make those assumptions to start with on what your volumes are going to be, what you expect your expenses to go up, and those kinds of things. And those assumptions should be approved by the board. So then from there, I think it's really important to get input from a variety of stakeholders.
To help organizations develop strategy, an understanding of financial position is required. The best way to see financial position is the balance sheet for most organizations. Since the balance sheet is a snapshot statement, that is, a view at a point in time, we can use this to understand the resources available to help support operations in those strategic goals. One key area for planning is the cash position of an organization. One complication is organizations have the flexibility to present cash investments many ways. Total liquidity could be presented as cash, short-term investments, and long-term investments. Another complication is any restrictions on funds. When we say restrictions, we're focused on external restrictions, for example, when a donor makes a contribution but requires the funds be spent on a specific purpose. Those funds could be in the bank, but not available to support general purposes. Another consideration on liquidity is any investment risk. A board member should understand and help monitor how much cash is invested in securities and markets. Development of a policy to specify how much cash is needed for operations versus investment is one option. An investment policy should detail how investments are managed, including how money is contributed or withdrawn from the portfolio, and the overall policy for what type of investments are allowed and any limits. The days cash on hand ratio is one common metric to understand liquidity. This measure shows how much cash and investments is on hand compared to daily expenses. Days cash on hand of 105, for example, indicates an organization could cover their expenses for 105 days without receiving any cash from revenue amounts. Think of days cash on hand as the buffer to protect organizations from negative developments. One downside of days cash on hand is it only considers operating expenses, salaries, supplies, benefits, utilities. It considers interest expense on debt, but it does not include principal payments on debt or any capital requirements, so it doesn't consider all demands on cash throughout the year. Understanding debt structure is another key area to understand the financial position. A board member should understand significant debt agreements for the organization, including annual payments, maturity date, and interest rate. An audit report here is a great resource as it includes the required disclosures and has details to understand debt agreements. Mary Ellen, what do you monitor to help gauge the financial position of an organization and their overall liquidity situation?
So to gauge the hospital's liquidity and just the overall financial stability of the organization, there's a few metrics that I think are really important. One is days cash on hand. And we always will look at that because that basically indicates how many days you can still operate your facility if your revenue stopped, right now. How many days out can you go? I know most organizations are running in about 150 to 200 days cash on hand. That gives you time to resolve problems without getting into a situation that you have to go get a line of credit or some money from the bank. So the other thing that is really important is your ability to pay your debts. So your debt ratio is extremely important. Most of us have a debt through bonds and things for capital improvements and things, and you want to be able to be sure that you'll be able to continue to pay that debt. The other thing that you may want to be looking at is your current ratio, and that's basically looking at how much you have in terms of assets versus liabilities. And again, it's how flexible you are in your ability to pay your debt and pay your expenses going forward, your payables that are out there, your obligations, so to speak. So those are the key things that I think you should be looking at when you're looking at liquidity of your organization.
Most debt agreements include covenants or minimum requirements. Days cash on hand is a popular covenant along with debt service coverage ratio. The coverage ratio shows if the organization is making enough to help cover its debt obligations. A ratio of 1 or higher shows the organization has profitability at a level to meet its obligations. If an organization does not meet those requirements, the board should understand remedies available to lenders or banks. The strictest covenants allow lenders to call the debt and force organizations to refinance or pay on demand. Another common remedy is hiring a consultant to develop a turnaround plan to help improve performance and meet obligations. Proactive monitoring and communication with lenders is crucial if covenant issues are present. Organizations should be closely monitoring covenants, and if there's risk of not meeting them, start preparing and understand how they will be resolved. Several outcomes are possible if covenants are violated. And in my experience, working through covenants is costly and time-consuming since many outside parties can be involved. Auditors, banks, trustees, and lawyers could all be involved, adding time and complexity to the process. As new debt agreements often include funding for large capital projects, this is also another area to understand. The capital allocation decision is one of the most important issues boards should be evaluating. Where do we use that next dollar of earnings or available funds? This is especially true in healthcare, since our industry requires high amounts of capital to remain relevant and support growth initiatives. The recommendation here is boards should be carefully scrutinizing capital outlays and understand how they support longer-term plans, which should naturally be happening since capital is a longer-term lived asset. Mary Ellen, what are some key considerations you have when evaluating capital plans?
So when you're evaluating your capital plans, I think some of the things that you need to be looking at is not only your growth strategies and some of the new areas that you may be wanting to start doing, initiating maybe a new service line and things like that, but you also need to be mindful of what you're working with in terms of your physical plant. A lot of rural hospitals have older physical plants, and we're putting a lot of money into just keeping them operating. I'm in a fairly new hospital. We're going to be about 15 years old, but with that becomes age. And so you want to look at your average age of your plant and keep up with the maintenance on that. It's not stuff that is necessarily going to generate new revenue for you when you're having to replace boilers and chillers and some of those mechanical things, but they're essential for your operations of your facility. So it's important for you to look at age of plant. The other thing that I think is important is how you determine how much capital you're able to spend each year. And we've always set a target for that. Sometimes it goes up and down depending on what we can afford or the initiative that we need to do. But I think it's important to set a overarching amount of money that the board is comfortable with and try to work with that plus or minus, a few percent here and there on each year. But to set that target and have that consistency and be proactive about your replacement of equipment.
One last area to touch on is how organizations are emerging from COVID, specifically CARES Act payments, PPP, and Provider Relief Fund. With the time left, there's not enough time to review these programs in detail, and much has been written about the programs as they were rolled out over the past few years. We did want to leave you with some perspective on the current environment and the financial impact from these programs. Organizations are generally emerging from COVID in a much stronger financial position. Organizations are showing higher days cash on hand from the stimulus injections. Some of this funding was designed to be repaid, but much of the support was designed to be permanent. The most significant funding for most was the provider relief funds. In short, to keep this funding, organizations had to incur lost revenues or expenses equal to the amount received. The reporting period for these funds started in November and continues today. The audit period for these funds is just beginning. Because of the audit process, organizations do have some lingering risk on these funds. The message today is to understand how much cash was received from Provider Relief Fund, and some prudence on spending these funds makes sense until all risks are resolved. Since organizations are emerging stronger, timing is great to revisit those strategic plans that were put on pause. COVID caused strategic planning to be a lower priority, naturally, and with a new sense of normalcy returning, being thoughtful with that improved position is one idea. One challenge or barrier to this is the current operating environment, which is much more difficult versus even pre-COVID times. Healthcare is mostly a price taker industry, so battling inflation and staffing pressures when revenues have limits on how much they can increase is causing many organizations to show losses. Mary Ellen, what are your thoughts on how organizations are emerging from COVID, and how should they plan for the next few years?
Well, one of the first things I'll say is that I don't think we're really over the pandemic. I think it's going to be something that we start to just address as an ongoing operational issue for the organization. And when we have a surge, we're going to address it and we're just going to keep going. And we want to be aware of the lessons learned from COVID and try to apply those into our strategies going forward. So that would be the way I would approach the post-COVID strategy world, is to try to take the learnings and bring those forward into the next generation of what healthcare will be.
Hopefully the presentation today has been helpful. and provided some information for you to take to your respective organizations. In summary, let's review the conclusions we tried to make. Finding the appropriate balance between operational, short-term, and strategic, long-term is an important consideration for boards. Engagement with the external auditors is a crucial function for addressing and monitoring financial controls and risk. Operational involvement should focus on understanding financial issues such as key business drivers, risk, and budgets. An understanding of the financial position, including liquidity, debt agreements, and capital, is a key part of strategic planning. Organizations are emerging from COVID in a stronger financial position, creating an opportunity to restart strategic planning and evaluate opportunities over the next several years. For additional information and resources on any of the topics covered in this video, see the resources guide that accompanies this series. We've also included some discussion questions and activities. We encourage you to reflect on these questions on your own and/or discuss them with your colleagues. To help you think through the information covered in this module applies to you and your hospital. The suggested activities will help you put the knowledge you learned in this video into action. And of course, feel free to contact the Center for any additional support.
Thank you for watching this video. For more information, refer to the resource guide or visit the Center's website at ruralcenter.org.